Hey everyone, welcome back to the channel. So in this video, I'm going to go over one of my new positions that I just entered into a couple of weeks ago. And before we start the video, this is not a recommendation to buy this stock. I'm not a financial advisor, and so you should always do your own research after watching this video if this is something that potentially interests you. So the company I took a position in is Maiden Holdings. Their ticker is MHLD, but I didn't actually buy the common stock. This is a company where I actually bought their preferred stock, which is right here. I bought the Series A preferred shares. This is the ticker symbol MH.PA. And we'll get into that, and we'll get into why I did that a little later in the video. But for a quick summary of my reasoning behind buying into this company, they just did a tender offer for their preferred shares at $10.50. The stock is still trading around that now, their preferred shares, and the par value of these preferred shares is $25, and I fully expect to get $25 for the preferred shares within a year or two at most. So first we're going to start off with where I first found this stock. So this is an article on Whale Wisdom Alpha, which is a website I like to look at. And this article is from April 2019, so almost 2 years ago at this point. So I've had my eye on this company for a while. So this article shows that the stock was down 91% back in 2019, but there was a ton of insider buying, and that made me curious about what was going on with the company. Usually when there's a large amount of insider buying, that means something good is happening. So we can take a look at the long-term stock price, and this is what happened. The stock was performing well up until around 2018, where we saw a huge drop from around $8 per share all the way down to under $1. And it was at this point where insiders were buying up shares. And so I figured, let me take a look into this and see what's going on in this situation. Now, Maiden is a reinsurance company. And so what that means is they provide insurance to other insurance companies. So if you have a company that does, say, car insurance, this insurance company is going to have all these car insurance policies, but in the event that they're all claimed at the same time, that would be catastrophic for the company because they wouldn't have enough float to pay out all of those claims. So what these insurance companies often do is they turn around and buy reinsurance to protect themselves in case that happens. And so Maiden Holdings is one of these reinsurance companies, and the worst thing that could happen to a reinsurance company happened with Maiden. They had reinsurance policies with another insurer called AM Trust, and so obviously this was catastrophic for the company, where at the end of 2018 they were expected to have an 18-cent profit in the third quarter, and then instead they came out and said they had a loss of $2.83 per share. And so this completely destroyed the company. Their book value fell by more than 50% just in this one quarter from all those losses they had to incur. Here is a look at the stock chart at that time, not pretty. But then after that, some interesting things started happening. There was insider buying. There was a hedge fund that announced a almost 10% stake in the company. So I knew this was something I wanted to keep an eye on, even though I didn't buy in at this point because I think there was still a lot of risk on the table about what was going to happen with the company. I wanted to see what their plan was to get out of the situation they put themselves in. Now, what Maiden Holdings did after this was they went into runoff, which means for an insurance company, runoffs mean they're no longer writing any new policies. Instead, they're just holding the policies they've already written and are running off their book of insurance claims. And so here's an article I sort of found talking about why a reinsurance company does this. And so here is a pretty good description. A reinsurer goes into runoff when it stops actively trading and ends its underwriting operations. And when this happens, they stop assuming new risk from other insurers and concentrates instead on minimizing payouts on its existing reinsurance contracts. So after these policies with AM Trust blew up, Maiden decided to go into runoff, which means they're just going to focus on taking care of the remaining policies, which means they stopped underwriting new policies and instead are just focusing on the ones they're currently holding. And in terms of the stock, when the company's in runoff, eventually all of the claims are going to run off, and at that point the company doesn't really have a function anymore. So at that point they would typically liquidate, where the bondholders would be paid first, then the preferred shareholders, and then anything extra would go to the equity holders. Now this is important because I think we're almost at the point with this company where there's a lot of value in both the bonds and the preferred shares, even the common shares, but I bought into the preferred stock since there's an extra layer of protection since the preferred shares get paid out first before any of the common stock, which insiders hold a large position in. And a reason I took a position in this company now is because it seems like they're turning things around. They recently got back to an operating profit, which is very encouraging after the very bad 2018 they had. So if we take a look at the company's income statement, this is by quarter, we can come down to the net income, and as you can see, the last 3 quarters this has been positive. So this is a very good sign, even though it doesn't seem like much, like last quarter was only 2 million. As long as their net income is positive, that is a very good sign for the company. And we can also take a look at their balance sheet to take a look at how their liabilities are doing, since that's also important as well for an insurance company. So as you can see, over the past 5 quarters, their cash has been piling up. They're now sitting at almost 200 million in cash. And we can take a look at the liabilities. Their total liabilities have also been decreasing by the quarter as well, which is what you want to see with a runoff insurer. So even though these liabilities do seem huge compared to how much cash they're holding, these are going to continue to run off as the company continues to phase out their existing claims. So over the past year, it seems like the liabilities are running off at around 200 million per quarter. And this is something I expect to continue until the point where they're able to pay off all their liabilities, retire the bonds, pay out the value to the preferred shares, and then anything left over would go to the equity holders. Now, as I said in the beginning of this video, the company recently did a tender. So they offered to buy back the preferred shares at $10.50 per share. And we're going to look at the results of this and why this is important. Because if you take a look, I hold the Series A preferred shares. You could also buy, there's also Series C and Series D. But from these results, you can see that around 545,000 shares were tendered, but there's over 5.4 million of these preferred shares outstanding. And what that means is only around 10% of the preferred shares were tendered at the price of $10.50. What this means is that a lot of investors in these preferred shares think that the preferred are worth a lot more and that they're going higher. Again, the liquidation or the par value for these preferred shares is $25, and this is what I'm expecting them to ultimately be worth either when the company's completed its runoff or when it's clear that the preferred should be worth par value. Now, here's the reason I bought the preferred shares as opposed to the common stock. I still think there is a risk of something going wrong with this runoff that the company is currently doing, and so because of that, I wanted an extra layer of protection. And so to do that, I looked at where the insiders of this company were positioned, and I want to be ahead of them. In other words, I wanted to make sure I would be okay if the insiders that own the stock benefited from that. So Maiden has a large amount of insider ownership. You can take a look at Wallmine, and this is sitting at around 34%. So insiders own 34% of the common stock. And this is beneficial to me as a preferred shareholder, because this means if the management is going to get anything, even 1 penny for their common stock, that means the preferred stock has to be paid out in full. And so because of that, I think it's pretty clear that management of this company is expecting the value to rise by a good amount over the next few years. And again, I'm in a position that I would get paid the full $25 for each preferred share before the management gets anything from the common stock. And there still is a very good risk to reward buying now at $10.50 and eventually redeeming the preferred shares for $25. Given the risk of this company, in my mind, is a very good risk to reward, and that's why I put a pretty substantial amount of my portfolio into this company. Now, this announcement just came out around a month ago, and it looks like Maiden is actually going into a new business where instead of being in runoff themselves, they're actually going to acquire from other insurance companies other runoffs or blocks of reserves. And so I think this potentially makes sense. It will allow them to bring in some more revenue. And with this management team, I think they're pretty experienced in these runoff situations. So I don't think they'll be taking on excessive risk by buying out some of these other insurance companies' claims. So in terms of what kind of return I'm looking for, I just went on this growth rate calculator, and so I put in these variables. My average cost is $10.50. That is the price that some of the preferred were tendered for, and that is when I bought in after that tender offer was announced. And like I said, I think these preferred shares are going to be worth the $25 par value. In my mind, I'm pretty confident about the risk that this company is taking on. And for me, it's really a matter of when, not if, the preferred will be worth $25. I am expecting the company to do another tender soon. Since the last tender, only 10% of the preferred shares actually got tendered. I think the company wants to take some more preferred shares than that off the table, so I do think they're going to raise the price into another tender offer within the next couple of months. But back to the return, if this takes 2 years for the preferred to be redeemed for $25, that would be a 54% compounded annual growth rate. And that is something I'm very happy with. Given the limited risk I think I'm taking on with this position, this kind of return is exactly what I'm looking for. Even if this took 3 years, it would lower the return a little bit, but it would still be a 33% return, which I am more than happy with earning. So that is my thesis on this company. Again, the position is the Maiden Holdings Series A preferred shares. The ticker is MHPA. And another thing I want to say about this is that this is a pretty low volume stock. It's preferred shares. It's a very small cap company. And so the average volume is only 17,000 of these shares per day. So there may be some volatile moves in And I don't know if this is going to happen, but as a result of this video, if a lot of people run into this stock, there probably would be a spike in the stock price. So I just want to get that out of the way now. There's always someone in the comments saying, oh, you're just pumping up the stock so you can sell. Again, I'm not planning on selling these preferred shares anywhere under the $25 par value. So I just want to get that out of the way. And again, always do your own research. Don't just rely on me in this video for your due diligence on this company. So that's it. Let me know down in the comments if this makes sense to you or if this is something you'll stay away from. I probably will do another video going more in depth because this video is really just a quick overview. I didn't really go in depth at all, so I will probably make another video going in depth into this company at some point. If you found value out of this video, hit the like button and subscribe so you don't miss any other videos I upload. So that's it for now, and I'll see you next time.